Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Hello and welcome to Bazaar Morning Call, live from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Sonia and Nigel, as always. It's a not so chilly but nice morning, right? Tuesday morning.
It's the best we can get in Mumbai in terms of the chill,
It's the best
right?
weather, right?
Yeah.
Absolutely the best weather. But one, I always think compared to Delhi, I don't know. Maybe I don't know, Nigel, but you being a Bombay person, to kind of go out in the evening and sit out, right?
It was beautiful last night.
It
was beautiful last night.
It's
last night was a little bit more chilly, I think so. I mean, in the morning it speeded away, but otherwise it was very pleasant last
I
night.
think these first few weeks of Jan are the only time we get in Mumbai is officially winter, right?
Yeah.
But you have to negotiate the pollution as well, all the smog and everything.
Yes,
but
yeah.
through that, if you can look through that, then you can see the chill and feel it.
Absolutely. The markets are not feeling the chill. Markets are actually quite warm and cozy. At least that's the way they've started 2023. And it's a distinctively different market and different feel to 23 as compared to 22. Maybe I've spoken too early. Maybe I will regret. But it does feel like, after what we saw on Friday last week, that things are looking a little bit better. Market participants overnight in US continued to trade the data from Friday, which is basically the ISM services and the jobs data, etc. There was nothing fresh. There was nothing new, no new information per se. Markets at one point were up some 2.5%. It was almost like a repeat, deja vu compared to Friday. But by close, they gave up gains. So take a look at the Nasdaq, for example, which is the one which did the best at close. It was up 0.63%, but it sold off 1.6% from the highs of the day. No particular one single reason for it, but both the S&P and the Nasdaq came off the highs, but techs did the best. The big global event, once again, is the macros. And there are two things, by the way. Today, later, we have the Fed Chair, Jerome Powell, who will make a speech. And then Thursday, there is the CPI. We'll get to the CPI, I guess, tomorrow. But let's tackle what markets are expecting from the Powell speech, or rather, what they're not expecting. What they don't want the Fed Chair to do is push back against market pricing. What do I mean by market pricing? After the recent drop in the the wage portion of the data, the jobs number, and the ISM services drop, the terminal rate pricing is now firmly below 5%. This is what the Fed will do at its peak. It's now below 5%, firmly below 5%, which means that this includes a 50 basis point cut, which is priced into late 2023. So markets, in terms of trying to assess what the Fed will do, has lowered how aggressive the Fed will be. The markets don't want Fed Chair Powell to push back against this pricing. He may. Just last week, when we got the December FOMC Fed minutes, what did the minutes say? The minutes said the markets get very loose in terms of financial conditions, and that is exactly the opposite of what we want. We want tighter conditions, not looser financial conditions. Markets rallying is looser financial conditions, and that is something which makes our job harder to do, which is control inflation. Asset prices go up, and they kind of seep through into the economy. So that is what they don't want. So if the Fed minutes, the December Fed minutes are any indication, we may hear something about that. By the way, from the time that the Fed minutes were released, markets have rallied quite substantially. The dollar is down about 2.5%. Equities are up some 3.5%. Yields are down substantially. Actually, the big move has happened in the yields market, the rates market in the US. So we'll see. But I think that's the big risk. If Fed Chair Powell, despite the cooling off in data, comes out tonight and says, well, you guys are still overdoing it. You guys are still getting too joyous at the first hint that inflation is cooling. We plan to do more. This is a long-drawn game, etc., etc., etc. We know the drill. All right. Let's just come back to the market here, the Nifty, right? So on the index, 18,200 is the first level to take out on the upside. The 20-day moving average, which was around 18,200, is now 18,194 as of yesterday's close. This 18,200 is also, as I explained yesterday morning, the 38% retracement of the full fall from the all-time high to the lows in December, 26th of December, which was 17,774. So it's a cluster at about 18,200, exactly about 100 points away from where we are. Bank Nifty and the lows, of course, at 17,774 should provide support. The bank Nifty has resistance at 42,860. It's a retracement of the fall. And then there is the 20-day moving average, which comes in at 42,985 for the Nifty bank. And for the banks, the support should come in around Friday's low of around 41,880. The market here also pulled back into close. I mean, the broader markets also pulled back. Market breadth, which was far in favor of advances, that closed the gap a little bit. But I would say on the Nifty, at least, it was still a solid close. And perhaps there is a little bit more to go. We can discuss the implications of what the TCS numbers can do one way or the other a little later. But I think they should not have an overbearing influence on what the index setup is this morning as we begin another session of trade. Guys, hi, morning.
Hi, morning. Morning, Nigel. And you know, the SGX Nifty for now is indicating that the start will be slightly on the muted side. It's down about 20 odd points. But there are a couple of positive triggers that I'm watching this morning, which perhaps could take the markets ahead. One is the TCS numbers. They were not as bad as what the market was fearing. So, you know, this is something, of course, that the street would like. The fact that the revenues have beaten street estimates, it's almost a 3% growth quarter on quarter. They're also confident of exit margins of 25%. The only niggling worry is that Europe is a big concern for them. So they're cautious on the growth outlook. But largely, you'd have to say that these are not as bad as the market was fearing. And the stock had a rally as well in anticipation of that. So that's the first positive. The second is that the FI selling has reduced considerably. So yesterday, FIs barely sold about 200 odd crores and there was large buying from DIIs. So have we found a floor around that 17,900 mark, which is the 100-day moving average? The US markets as well consolidated their gains. The Nasdaq ended well in the green, up about 60 odd points. It's the second day of gains over there. And very strong gains in the European markets too. The FTSE was up over 200 odd points. So the big question is, the Nifty managed to conquer that 100-day moving average of 17,900. Does it become the near-term floor for the market? Looks like, at least with these positive cues, that level could hold. The pullback could perhaps extend itself. And of course, there are other positives as well. Brent continues to be below $80 a barrel. So we have more positives than negatives this morning. Let's see. For now, the SGX Nifty is indicating a slightly muted start. But I guess a lot will also matter on the commentary that the TCS management makes. So we'll await that very soon.
Well, that's right. You know, Sonia, for me, the biggest cue coming in overnight was the dollar index. You know, that's cooled off and I like that. You know, from an emerging market perspective, for me, that's the big cue. It's cooled to around 103 odd. So that's good news. But yesterday, we had a great trading session. A pullback was on the cards, and maybe, in fact, on the data points that came out of the United States, that was the reason that we pulled back. So from oversold levels, we did see a good pullback. The good point as well is 17,800 yet again got defended. So in the last 20 days or so, we have gone to that level twice, and it's got, we have pulled back from there. The Nifty bank, you know, the intraday chart is telling you the picture. It was underperforming till around 2 p.m. odd, but then it found some form, and you like that as well. And hopefully that continues from a bullish perspective. On the institutional flows, well, the FIs, as Sonia said, net sold close to 200 crores. That's the lowest in the last 12 sessions. You know, that's the lowest since December 22nd, in fact. And institutional flows, that's the DI and the FI number. I look at it together. Last few days, we were hovering with the net sell number of around 1,800 crores. Well, that turned yesterday. We had a net buy number of close to around 1,500 crores. Part of that, you know, that FI smaller number coming in is what Nimesh had to tell us yesterday in the final hour of trade. He said there was some ETF buying that was likely. So maybe because of that, we had a bump up out there. And that's why the FI net sell number was much smaller. What are the FIs doing in the F&O market? Well, there was some short covering. And for the market on the whole, the Nifty bank, there were bigger shorts that got covered out there. That ties in perfectly. Yesterday, the FIs added some long positions. They covered some short positioning. And now, you know, the short positioning has come down to around 51%. At the, sometime last week, it was 64%. It's come down to around 51%. So some part of the short covering bounce has played out. On the option side, well, they were writing calls. They got stuck on the wrong side. There was calls that were written earlier. They got covered. And put writing came back into play. 18,000 put, 18,100 put. Both of them got very active yesterday. And I'm looking at the 18,100 put. The premium out there was around 75 rupees. At the start of the day, it was around 140 rupees. So you punch that number in and, you know, you get a support of around 18,000, 18,030. That's for today itself. At higher levels, you're looking at the 20 and the 50 DMA. The IT stocks will react today. But for me, the Nifty bank, that's the joke on the pack from a bullish perspective. Can it get past the 20 DMA? It's around 100, 120 points away from those levels. So this dip at some point of time, my gut is going by the data points. We have some unfinished business on the upside till around 18,250. So maybe get a deeper gash. That should be a good entry opportunity.
All right, well, let's wait by lots of cues lined up later this morning. So we will begin with the equity call of the day. First up, we have Chetan Seth of Nomura, who says the developments over the past few weeks continue to support their constructive view on Asian equities in 2023. He says China's reopening momentum has been faster than market expectations, though it has resulted in a temporary surge in new cases and depressed mobility. He thinks investors should and will look through and focus on an eventual economic earnings recovery later in 2023. On the global front, he says US inflation has been moderating with multiple months of declining month-on-month inflation prints. He remains tactically bullish on China stocks and believes that there are legs to this reopening recovery-driven rally.
Well, let's get you some money market views as well. Bhaskar Panda of HDFC Bank says that the dollar index moved down a bit overnight in the hope that the US policymakers may be able to manage a soft landing. He says oil and metals have firmed up a bit. And surprisingly, the dollar-INR pair has moved down yesterday as INR gained against the dollar, riding on better flows. He says since dollar index is easing and there is optimism on flows, expect the dollar-INR pair to trade in a range of between 82.2 to 82.5 to a dollar for the day.
All right, on the bonds, Bhaskar Panda says yields and benchmark indices have tapered a bit on the basis of perception of US rates and favorable oil prices. He says the trend is expected to continue as he expects the 10-year benchmark bond yield to trade in a range of 7.3 to 7.35% for the day.
All right, well, we have a lot of stocks that we're going to be tracking for you, and we'll get to that in just a bit in our special Top 10 segment. We're looking at Big Boy, TCS, Tata Motors, Sona BLW, Precision, Lupin, IRB Infra, IRB Invit, ONGC, and KRBL. All of them on the back of positive news flow. While on the flip side, you have JSW Ispat and Tega Industries. They are stocks that could open up in the red.
Okay, so that's basically the lineup here. Now let's listen in to Liz Young, Head of Investment Strategy at Sophie, on the strategy in terms of inflation trajectory and the outlook for the US markets from here out. Listen in.
It's possible and probable that inflation comes down pretty well in the first half. It might come down very, very quickly, and the market is going to cheer that. The move on Friday was really predicated almost solely on the fact that wage growth relaxed. And we got this jobs data on Friday that kept the hope for a soft landing alive. The only thing I would caution people on is that the stock market and wage growth alone does not reset the economic cycle, does not solve all of the problems that we have. The risk of a wage price spiral maybe got reduced for a little while, but that doesn't mean that the risk is gone. And what we're seeing right now, especially in some parts of the labor market, definitely parts of the consumer data, is that economic data is weakening. If you want inflation to come down, you have to bring demand down. That affects consumer spending, that affects corporate profits. I don't think we've seen the end of the bad news. I'm not a short-term trader, so if you look at just where would the growth be, where would I bite if we're trying to find growth, it's probably not in tech, it's probably not even really in large cap at all.
Okay, so it may not be the end of bad news across the globe. That's the word coming in. But Dalal Street ended its 3-day losing streak yesterday. So will that uptrend continue, or is it the start of an uptrend? Time will tell. We take a quick break. When we come back, our entire team will be with us to help us with the list of top 10 stocks. Stay tuned. Well, hope you're having a good morning so far. There are lots of cues to deal with this morning. So without wasting any time, let's get our entire research team in. Rima joins in first up to tell us about TCS's numbers. Rima, it wasn't as bad as what the market was fearing?
Absolutely. In fact, the revenue was better than what the street was anticipating. Dollar revenue grew 2.9%. Constant currency revenue grew 2.2%, ahead of street expectations. Margins and profits came in slightly lower. Margins improved by 50 basis points. The street was anticipating about a 70-80 basis points margin improvement, and the miss in the profits was on account of the lower other income. But even as the Q3 margins missed the mark, the company's guidance on margins is positive. They maintain that by Q4 FY23, the margins will improve to 25%, which basically means in Q4 we are likely to see the quarter-on-quarter margin improvement. Attrition has ticked lower after 6 consecutive quarters of an increase. And if you look at the quarterly annualized attrition, it's sharply down by 600 basis points. Also, the management indicated that even as decision-making has slowed down across certain geographies, their qualified deal pipeline has gone up. But talking about the negatives in the numbers, the deal wins, the TCV, the total contract value as it's called, is down nearly 4% on a quarter-on-quarter basis. It's within the company's guided band of $7 to $9 billion, but at $7.8 billion, it's lower on a quarter-on-quarter basis. The headcount addition, the overall employee base has declined sequentially by 2,200 employees, and over the past decade, TCS's headcount has declined only in the last 3 quarters. The problem is, while Q3 is pretty intact, there is no clarity, no visibility on what the future demand, FY24 numbers are going to look like. The management commentary was constructive on 2 vertical geographies, North America and UK, though they are pointing to rising caution in Europe, which is about 15% of their revenues. They say the deal momentum and pipeline remains robust, but calendar year 23 budgets are still uncertain, and it will take a couple of months before they get clarity on what the tech budgets are going to look like. Back to you.
All right, Reema, thank you. Thanks very much. That's a comprehensive snapshot of the numbers. We'll also be in conversation with the TCS management in just a short while from now to decode the third quarter performance, the management, which you will see coming up on your screens now. So that's a conversation which follows in a bit. All right, we'll come back to TCS, but staying with the Tata Group, but Tata Motors now on the auto side. Sonia's going to tell us why. Sonia.
So I'm going with green for Tata Motors this morning. They report their quarterly JLR wholesale numbers and it's looking pretty good. So the management says that the wholesales in the third quarter have risen because the chip supply has gradually improved. The JLR wholesale numbers are up 5.7% quarter-on-quarter and 15% year-on-year, coming in at just under 80,000 units, which is very good. There's a significant increase in the production of the new Range Rover as well as the new Range Rover Sport. And there's a record order book that Tata Motors is seeing on JLR at over 215,000 units. Now, the client demand is very strong, particularly for the new Range Rover and the new Range Rover Sport as well as the Defender. If you look at the geography-wise breakup, it's North America, UK and the overseas market which are doing very well. North America has risen 17%, UK is up 13%, overseas market up 10%. China is still struggling because China was impacted by COVID, as we know, and Europe is also down 3%. We all know that there are big problems in the European markets. Now, Morgan Stanley put out a note where they said that this trajectory of Tata Motors will help them generate 400 million pounds of free cash flow in Q3 and hence will help them achieve their free cash flow positive target. So I'm going with green over there.
Okay, all right, Sonia, but you're tracking another one, Sona BLW Precision.
Yes, because they've made an acquisition. They've acquired a Serbian company called Novelic. 54% stake has been acquired for 40 million euros. Now, this is a leading provider of wave radar sensors, perception solutions, and full stack embedded technology. And this will allow Sona to get into the high growth sensor and software segment. Now, why is that growing fast? It's because of this entire EV space. The management, in fact, expects this segment to potentially touch $100 million in 6 to 7 years. The acquisition will be funded entirely through internal accruals, so no debt, which is positive. The transaction will be closed by Q4 of FY23. It will be EPS accretive from the first year, according to the management. And the deal values Novelic at an enterprise value of 75 million euro. Now, Nomura put out a note where they say that the growth opportunity is very high in this sensor segment as vehicles become electrified and autonomous. They continue to like the company's strategy of focusing on high technology products. They maintain a buy with a target price of 609. So this is going to be taken very well by the street, going with green over there.
All right, so that's autos in focus. Well, let's talk about Lupin now. Ekta is standing by with why we're talking about Lupin. Ekta, hi, morning.
Morning. Well, Lupin is in focus because they've received the approval from the Spanish government for the reimbursement of Lupin's drug Namiscula, which is basically in Spain. Now, this is going to be commercialized with their partner in Spain, Equities. But this is overall positive for Lupin, possibly because this is one of the few drugs which is available for this particular neuromuscular disorder which it treats, which is extremely rare. And hence, with an insurance reimbursement in Spain, they're probably going to see more traction for the drug. So maybe we could see a positive momentum on Lupin this morning.
Okay, all right. Thanks a lot for that, Ekta. Well, let's wind this down with Vivek. Vivek, tell us about all the other stocks in the news.
That's right. Quite a few stocks on the radar. First we have the IRB twins. So IRB Infra, the company has given out the December toll collections on a month-on-month basis. Up almost 6%, coming close to the 388 crore mark. On a year-on-year basis, up almost 32%. This has to be kept in mind in context that last year, that is December 2021, toll collections were suspended due to the farmers' agitation. A similar story even across IRB Invit. Toll collections up, steady, almost 1.5% higher on a month-on-month basis. On a year-on-year basis, up 18%. Now, IRB Invit has stopped collecting toll from December 16th of 2022, again due to a farmers' agitation. And even the base month last year, there was a period of 15 days where the company did not collect toll. Despite that, it's a steady toll rise as far as IRB Infra as well as Invit is concerned. JSW Ispat, the operational update has come in. On a year-on-year basis, it's been quite muted, down almost 30%. JSW Ispat, as you may be aware, was earlier known as Monet Ispat. The other stock on our radar, ONGC, some positive news flow coming in there. The production, newspaper reports indicate that the production at Russia's Sakhalin-1 block will reach normalcy by March of this particular year. Now, remember, they are expecting a significant rise as far as daily production is concerned, currently around 140,000 barrels a day. They expect it to rise to almost 200,000 barrels a day. KRBL, the company has launched a significant marketing campaign, mainly to shift consumer preferences. And lastly, keep an eye out for Tega. The CFO of the company has resigned with effect from January 31st, 2023. Some negative news flow coming in there.
Okay, thanks folks for giving us all of those stocks that are in the news. In case you missed out on them, there's a quick recap coming through. TCS, of course, post numbers, Tata Motors, Sona, BLW, Lupin, IRB Infrastructure, IRB Invit, ONGC and KRBL are positive news flow stocks. While on the negative side, you have JSW Ispat and Tega Industries. But the one cue that we continuously track day after day is the movement in crude. Crude has been falling and now below $80 a barrel once again. Manisha Gupta is joining in for quick commentary on that. Manisha, morning.
Morning, Sonia. Thank you for that. Well, New York session is the major volatile one. Yesterday, we did see prices bounce back to $81 per barrel as well. Before we closed the session for US, it was back below 80, and that's exactly how Asia is trading right now as well. While there are recovery hopes from China, but you still are looking at weaker demand from China there. The markets also are looking at higher production from OPEC and allies, and Saudi Arabia cutting prices for Asia and European customers also continues to weigh onto the prices. But it is the metal sector that you should keep an eye on, because we've seen prices gain up between 2 to 3% overnight as China moves away from zero-COVID policy, as you are looking at elevated energy prices hitting smelting in Europe and Africa, and multi-year low inventories are supportive. So we are looking at multi-month highs for steel, iron ore, copper, zinc. I mean, these are the metals that gained anywhere between 1 to 3% overnight and have started Asia positive.
All right, Manisha, thanks very much for that. We'll take a quick commercial break here. On the other side, the promised conversation with the TCS top management to discuss the third quarter performance and the outlook going forward. Stay tuned.
Welcome back, and the TCS top brass is here. We have with us NGS COO and Milind Lukkad, the CHRO, actually the more important person in a company like TCS. Gentlemen, good morning and thank you very much. Congratulations actually for beating street expectations. I have a lot of negative scenario questions, but first the positive one, NGS. 2.2% growth and an improvement in margins is not a small achievement given the circumstances. So what led to that, both these positives?
I think it's a very, very satisfying quarter, 13.6% year-on-year growth. I think we stayed very focused with customers, being part of them, working with them, put feet on the ground to see what matters to them in these tough times, right? Especially as they grapple with uncertainties in the macro side. What does it mean for them to stay ahead of the curve? Where is it that new technologies can help them bring efficiency, help them bring automation, and then at the same time work with them to define the future now, right? And I think that's what really is. In a nutshell, I think it's about cloud, right? Everybody moves everything to cloud. And
as you call the race to cloud.
Yeah, race to cloud. And then it's about, you don't stop by moving to the cloud. You keep improving it. You keep bringing in automation. The beauty of these digital technologies is that a new technology comes in, a new way of working comes in every month, right? So short is the improvement possibilities, with the result that customers are always willing to adopt something new for bettering the growth, bettering the efficiency, and bringing innovation to differentiate themselves in the marketplace.
Okay, well, I have more on that, but before that, Milind, while it is a large number you hired in terms of freshers, the street is a little worried that your total headcount is actually a few thousands less. Okay. Is that preparing for likely fewer orders in this year?
So a couple of points I would make. One is basically if you look at year on year, we have grown by 57,000 people. Yes. So that's almost 10% growth on the number which we had last year. And we also hired a lot of people last year, and basically close to 200,000. Yeah. And then a lot of talent development over the last 3 quarters, and eventually they are getting deployed now, in this quarter, and thereby increasing the utilization a bit, and also efficiency in the organization is basically causing this headcount to come down. But actually, if you look at it, look at 2 years together, I think will be even.
Yeah, but it's only the third time in in the entire record of TCS quarterly that it is lower. So is there just a preparation?
It is.
Let's look at the orders and then hire.
Let me assure you, it is nothing to do with demand. Okay. It is everything to do with efficiency, and it is everything to do with investment which you made.
Fair. And she just wanted to talk about your deal wins. In FY22, the total contract value or the deal wins went up by 10%. And that's helping you clock in a double-digit growth this year in FY23. 9 months FY23 TCV is up only 3%. Does this not signal that growth next year will slow down?
I don't see it that way, but I think it's a function of the order book that we have, for sure, that we have to keep executing it. As we see it, there is a very strong pipeline. As I said, the qualified pipeline looks very good. In certain markets, the decision making has been a little slow, but we don't attach too much to the macro situation and the client situation, because we work very closely with customers. If you look at UK, for example, when so much of uncertainty around, we have grown year on year that market by 15.4%. So I think across verticals, whether it's a broad-based order book that we have got, broad-based pipeline that we have got. So the kind of execution rigor that we have brought in, the kind of growth that we are seeing in the cloud and artificial intelligence and machine learning kind of work. So I think it all looks positive and gives some weight for the macroeconomic uncertainties, especially in Europe, where the decision making will become clearer in the next 6 to 8 weeks' time.
But there is a correlation between the deal win growth rate and future growth, right?
Yeah. No, it is there, but some of them are multi-year deals. So you have to look at it from a perspective of, for example, whatever the deals that we clocked last year, it's typically it's not for just 1 year. It's for a multi-year life cycle, multi-year deal. So in the short term, if you really look at it, for the order book that we have for the coming year, 23 and 24, looks positive. I think we've got an order book which we have to execute well. As long as we execute well, which we are really good at, I don't see a particular challenge in it.
Okay. Just one more question about Europe. You repeatedly said in the press conference Europe is challenging. And that's 15% of your revenues. Is it just slowness in decision making, or are you seeing deal cancellation or no new order wins? What's happening in Europe?
See, there are 2 ways to look at it, right? In these kind of certain uncertainties and amount of caution that the customers express, First thing is the cost and optimization, vendor consolidation. Those kind of opportunities are really picking up in Europe, right? Those are the ones which are getting accelerated. So there is a consolidation opportunity, there is a market share gain opportunity for TCS.
Even in Europe?
Even in Europe. But on the growth and transformation side, people are wanting to get this winter over, right? And see that, look, in that sense that the next 2 months are going to be the key thing. But at the same time, they all recognize that the journey to cloud and journey to a cloud-native, microservices-driven, ecosystems-driven architecture in which they want to redefine their future is irreversible. You know, they've gone that path. The pace might take a little slow, but you know, if they delay it for too much, then the technology change will be too huge.
So you're saying that transformational deals are taking time. Those would be the high margin ones, right?
Yeah.
So can we say in a nutshell, in Europe, cost optimization deals are intact, but growth and transformation deals have taken a pause right now. There is a delay.
Yeah, it's fair to summarize like that.
Okay. Well, Milind, I wanted to ask you, how are the wage hikes in your off-site categories? I mean, I'm trying to gauge how severe is the wage pressure abroad.
I think what we have given last year, I think we don't expect that to change in the coming years.
Okay, okay. Because
so it is. So I think
the macro numbers are indicating wage pressures are stiff.
Yeah, it is there, but we have been able to. That's why we have been able to manage and our operations efficiently and effectively, and just ensure that we actually do similar to what we do normally every year. And I don't see that changing right now.
So there is a pressure there.
So I think, but you know, we have to respond to those pressures very, very well, right? By operating it better, by being able to price it better, all of our deals and all of those things come together, and thereby we are able to do that. And I don't see actually again see that changing in the coming years.
Okay. NGS, yeah, 1 minute. NGS, I just wanted to know whether there were sectors that gave you more orders. I'm looking at it from a macro standpoint. While there were pressures in, you know, for instance, retail and finance, Goldman Sachs has sacked people. We've heard positive things in commodities, metals. Do you all also service those sectors, and did you find more orders there?
It's a fairly broad-based growth that we have seen. For example, retail, CPG and travel and hospitality grew upwards of 17-18% for us year on year. Banking, financial services grew by 11%. Manufacturing grew by about 12%, and rest of the verticals grew between 9 and 10% year on year. Even in the order book that we have, the pipelines that we have, both in terms of mid-sized deals as well as large-sized deals, is very, very broad-based across markets, across verticals. So even the large deal pipeline looks good. We are working on some key large deal opportunities which we hope to convert, going into the next financial year, right? So overall, you know, I do not see any slowdown in terms of the deals that are coming into the pipeline, right? But the decision making in certain markets are a tad low or delayed, given the uncertainties that they want to take into account.
So TCV to revenue may slow down. That is, book to bill may slow down.
No, TCV to revenue will be intact, but making it into pipeline to TCV might get delayed.
Qualified pipeline to TCV.
TCV might get delayed a bit, specifically in growth and transformation opportunities.
Okay. Milind, FY22 was a supernormal year for employees of TCS, right? Not just in terms of wage hikes, but you gave a lot of bonuses, etc. Do you think next year we will see an overall lower wage bill for TCS? Because attrition is easy? Overall, including bonus.
I think like I said earlier, I don't expect that to change, but we'll obviously play it by the year and see how the situation evolves and based on the decisions.
How much may attrition ease, you think?
Pardon?
How much may attrition ease?
No, I think, this quarter itself, although LTM wise we are 20 basis points lower, but if you look at quarterly annualized attrition, we are close to 6% down. And I expect that trajectory to continue.
Just one final word, Milind. Wanted to get your thoughts on this global tech layoffs. What did the global tech companies get so wrong in their hiring that they hired aggressively post-pandemic that they now need to course correct and retrench?
It would be very difficult for me to comment on somebody else.
Your best place to comment on it.
But I think I think over the years we learned what is required and what is needed and what is the best strategy for us, and that is working for us, and we'll continue that way. I think the point is it's all about caring for people. It's all about making them feel that they are at home when they work for TCS. All of these things actually happen when people come from the campus and make TCS a new home for them. And that cultural transformation happens in them, and a long-term overall view of looking at this as a career, not as a job. All of these things work well for us, and we'll continue to work that way.
That still doesn't explain why the tech companies got it so wrong. But I take your point. I mean, I think the most encouraging part is that the fall in the workforce is not demand-led. I think your investors will take it very positively. Thank you very much, NGS.
Thank you.
Thank you so much.
Back to you.
All right. Thanks a lot, Lata and Rima, for that. A very, very insightful and engaging conversation with the management of TCS. They're saying that the order pipeline is quite strong, although decision-making is slow in certain markets, but they're satisfied with this quarter's performance. Dipan Mehta, director at Elixir Equities, joins in now. Dipan, I can't put my finger on whether the management commentary is optimistic or cautious. You tell me. How have you looked at the numbers? Numbers are at least not as bad as what the street feared. And how are you positioned on the stock now?
Good morning, Sonia, and thanks for having me on your show. I think the numbers are excellent. To get a 19% type of a top-line growth rate in rupee terms is quite exceptional given the challenging times. And I think now what is happening is that the growth in revenues is matching the increase in the employee cost. And at some point of time, the growth in revenues will exceed the employee and other costs which the company bears. And that will mean positive operating leverage for the company. So, the growth slows down to say 13, 14, 15% or so, but the expenses will be lower and they'll start getting benefit of the operating leverage. And that's how the net profit momentum will continue. Given the way the stock price has corrected and these numbers, and I would say cautiously optimistic commentary from the management, we are quite positive on TCS. And I don't know how the stock will trade today because it's difficult to make a call. But maybe I think the worst of the correction of the IT stocks may be behind us if other companies also follow suit and declare similar type of results.
All right. Hi, Dipan. Morning. So you're fairly impressed with these numbers. I just had wanted your opinion on this. The promoter entity out of this dividend, they'll be getting close to 20,000 crores odd. I'm just wondering, where will they deploy it? Will there be some of the listed or the unlisted companies that they'll pull out this money in? Because it's a large sum of money we're talking about, $2.5 billion. What's your sense in some of the other group companies, like a Tata Motors? Sonia has been telling us about some news flow that's coming in there. Your sense on it? And, I think in the next couple of weeks or so, maybe we could hear something with regard to deployment of this money. That's just a guess, because it's a large sum. Go ahead, Dipan.
Yeah, well, Nigel, good morning. I can think of two ventures which require this money. One is, of course, the aviation. There's going to be a massive investment over there from the Tata side. And secondly, the digital businesses, all the new apps which they have launched, and there's intense competition over there as well to get the e-commerce business going. So these are the two ventures I think they will invest in very heavily. I'm not certain that money is required by Tata Motors or Tata Steel or any of the large listed companies of the Tata Group. But in any case, I think it's great news for Tata Sons that they're getting this kind of an income in at a time when they want to rev up their investments in a whole host of new age digital businesses and aviation as well.
Okay, guys, I just was looking at it. I think Tata Motors, they're going to be delisting that ADS, right? So for those who don't take it, there will be a bit of an overhang out there because as of now, there is 4.5 to 5% of that stake in the listed entity. So let's see how that plays out. But just as an observation out there, because I think post-January 2023, that ADS will not be traded as well.
All right. We'll keep eye on that one as well. Deepan, hi, good morning. Just a quick word on the market itself. Do you sense this could be the beginning of a bit of a pre-budget kind of a move, what we saw yesterday? Or do you think unlikely? What's your sense?
Good morning, Prashant. I think it's going to be all about earnings. And yesterday, the tide turned for IT stocks on the expectation of good TCS numbers. And I hope the street takes these numbers well. And if that is the situation, then I think it will be the earnings which will be the main catalyst for the markets to, having turned around to build on the gains which we have seen for the past 2-3 trading sessions or so. and then take up from there. Budget, I think, is important, but by and large, I think budgets have become less and less of a market moving event. There's a one day, single day or two volatility. But end of the day, I think the way the budgets are designed these days, there's not much in terms of what the street can take out of it. Sector specific anyway is part of GST. And only thing the street looks forward to is if there are any changes on the direct taxes side. And I hope they don't tinker with the capital gain structure of equities. I think if there's no tinkering over there, nothing adverse comes to, I think markets will take budget with both hands.
Okay. Just coming back to that, discussion that we were having on the Tata Group, on Tata Motors particularly, what are your thoughts, Dipan? The numbers are not looking bad at all. In fact, it's a good growth that we're seeing, a 15% growth year on year in JLR wholesale numbers. Now the chip supply issue has also eased. Certain markets are picking up, except China. Is this a good time to be buying Tata Motors?
No, Sonia, we start to avoid Tata Motors. Within the auto space, there are better choices. M&M, Maruti, Eicher Motors. The problem with Tata Motors is it's a very complex company and they operate in very different markets, and it's all about JLR. And while China starts to do well, they'll have problems in UK and Europe, and then USA is going into a minor recession or so. So sales get impacted over there as well. So it's very complicated to get a handle on Tata Motors earnings. And there's not high degree of visibility or visibility of growth in earnings. And keeping all of that in mind and considering the kind of trend which is there more and more towards EVs globally, I think Tata Motors is best avoidable at this point of time. We like M&M, we like Maruti, Eicher Motors. They're sitting on good order booking. Margins have stabilized over there. Great deal of visibility because of the kind of popular models which they have launched and the response which they have got to those models. And overall, I think, there's a increasing consumer spending taking place, and that I think benefits auto companies as well. So, as I said, there are better choices per se.
Oh, right. There are better choices. Got that. Dipan, we need to take a short break, so just keep it with the channel. We'll come back in just moments from now. Lots more to talk about. We have the TCS management, the rest of the top brass, Rajesh Gopinathan, the MD and CEO, and Samir Seksaria, the CFO at Tata Consultancy, will be with us to declare their Q3 numbers. Stay tuned.
Welcome back, and now we have the big two from TCS, Rajesh Gopinathan and Samir Seksaria. Gentlemen, thank you very much. I know it's been answering the same questions again and again, and I'm going to try and ask it differently. Let me take it from my macro angle. I cover economics, and what the IMF tells us, 21 growth was 6% for global economy, 22 was 3.7, and 23 is going to be 2.1. I mean, it's huge. 1/3 what we saw just 2 years ago. How would you see the impact? I mean, just what red flags in your world?
First of all, good morning and very happy New Year to both of you and to your viewers. Thank you for having us here. Our business is on a very focused customer set, both from a market perspective as well as from a client universe perspective. So the way I would look at it is, rather than try to parse the overall big global economy picture, if you go to large enterprises in the big large markets like US, UK, Europe, which together constitutes somewhere in the range of 80%, 85% of our business. And as I said, again, we are talking of large enterprises. One way to look at it is that enterprise balance sheets have never been as strong as they are today, compared to 5 years ago or 10 years ago. So balance sheet repair has happened. The EC money actually resulted in a fairly good disciplined execution on that side. The financial markets, of course, react to the repricing of the asset on terms of where the interest rate is. But when we are looking at actual individual companies, they are more impacted by the supply chain issues, which have kind of played out through the year. They are in fact on the absolutely on the getting mended. Geopolitical issues in Europe will continue to have an impact, especially for that market and for some of the long supply chain kind of industries. But others in UK, in US, they're in a much more stable situation. So our own view is that will be some impact of the overall negative commentary that is there in decision making. But when we take, let's say, a 6-month view or a 12-month view, we are much more positive, because we believe that our client universe, their underlying business is in good shape, and that is what is driving our positive outlook on our business compared to where the overall economic commentary is.
Okay. Samir, I wanted to ask you about the margins. It's impressive that at a time like this, you are, not only delivered better margins than quarter ago, you're promising to exit at 25%. How are you so sure, and what led to that improvement?
Okay, fair. So I think this is still an aspiration, but we have put it out at the beginning of the year when we gave our full quarter increments, and we came in at 23.4. We said we want to exit this year at 25, and structurally we have worked towards it. If you see in both last quarter and this quarter, we have been able to get improvements. Two specific parts to it. One is we have been focused on execution rigor, and bulk of it is coming from the execution rigor, whether it was in terms of the churn which we went through the last year, and the capacity building which we invested into last year, that coming into productive capacity and helping us on the utilization side, realization, the factors which we called out.
And there is still space over there?
There will be operational levers from an execution rigor perspective, which always will be there. Fees to external consultants still provides us an opportunity. There will always be puts and takes in terms of how it would set up. Second factor is currency has been beneficial to us, and that also we have been calling it out.
That may not be there this year, we are told.
Let's hope.
Rajesh, just talking about Q3, what explains why you didn't see higher furloughs when your peers did and called out specifically?
I think it's a question of, it's been quite a few years also, Rima. So to exactly, and to say that it is higher or lower, the variations are not that material to be a commentary item. So what we have said is that it is regular, it is coming from the same, so we have more than the volume. We have put our commentary based on where is it coming from, which markets is it coming from, which industries is it coming from. Are we seeing something completely surprising, some industry that never used to do furlough, standing up and talking about furlough? So none of that has happened. The actual volumes, it's not that material to be, the variation is not material enough to be called out.
Samir, you've announced a special dividend, as in the board has announced a special dividend of 67 rupees. Does this rule out a potential buyback? Because the window for the next board, a buyback announcement, is in the next couple of months. So should we expect no buyback from TCS?
So, see, our capital allocation policy has been consistent.
Yes.
And if you look at technically, as the regulations currently stand, we couldn't have done a buyback in this year. We completed our last buyback because it has to, at the end of March. So if we had to do something in this year, the buyback option wasn't available. On an ongoing basis, we look at a combination of various measures of distributing cash flow, and it could be both dividends as well as
buyback. So a buyback could be on the cards in Q1 FY24 when you are eligible?
That's always an option available.
Okay, that's the nearest you will come, is it? Okay, Rajesh, I'll tell you, from what the investors took home, the two big fears are that your TCV, your total contract value, was only 3% higher. Last year it was 10% higher. Your total workforce is actually a few thousand lower. Both these look like 23 is going to be difficult.
Lata, actually, I should have had that number, but our TCV is now, earlier it used to be in the 6.5 billion range. Now it is consistently staying in the 7 to 9 billion range. So on an average, if you compare it, because TCV by nature is volatile. So on an average, we are not, we are in quite a good shape. And we have always said that the multi-billion-dollar deals are one-offs, and that needs to be, you cannot predict as to when it will come. So overall TCV trend lines, and so there are three layers to it, right? Overall pipeline, qualified pipeline, and then the TCV. Everything is in a fairly good shape. The place where there is weakness, we call that out in Europe, where qualified pipeline continues to grow, but the actual decision making and closure on the contract side is getting delayed. And there we see a definite decline, which is where our commentary on Europe is a bit much weaker than what it is about the rest of it. Whereas if you take US or UK, deal closures are continuing at a fairly good clip. In fact, UK had specifically called out, though the overall operating environment is challenged, actual decision making is very positive, and people are moving forward with transformative projects.
Okay. Yep.
Rajesh, you are confident about a double-digit growth this year, FY23. Are you as confident? How are you thinking about double-digit growth for FY24?
This is a milestone quarter for me. This is my 40th quarterly. So batting back this question again and again. So keep that in here, that we don't want to get drawn into making a specific comment. But otherwise, as I said, these 2 years have been a fairly strong growth years. The next year is like more a balanced year, a consolidation year, both on the revenue side as well as on the overall profitability side. The perspectives are very different depending on the markets. And I think the most important one is that we have a divergence in US between what the larger commentary is and what our own perspective is. In Europe, we are fully aligned to where the macro commentary. And UK, we are executing totally differently. In UK, we are now by far the largest technology services provider. So significant market share gains, significant growth, very clearly highly differentiated positioning. All of that is playing out. So overall, it's a good, I just used this analogy earlier, that it's a good test pitch.
Okay.
There's
so
something in it for everyone.
15% which comes from Europe, you see, is under threat.
Absolutely, where there is clear, and another 15-20% which is from all the other markets, about 15%. They are very volatile to call, so they are difficult to call in any given year. The 15% Europe, which has been a big growth driver for us till last year, that is off the boil and likely to remain soft in the near future.
Rajesh, on the conference call yesterday, you said that you have won 20 optimization-focused large deals in the first 9 months of this year, versus 16 in the similar period of the previous year. So 20 cost optimization deals versus 16. What would the same number be for growth and transformation, where we are seeing some slowness?
I don't off the have it, which is one of the reasons why I hesitate to give these numbers, but I don't have the cut on the other side.
But is it significantly lower?
Not, so on a quarter-on-quarter basis, our deals have been equal. That is between Q2 to Q3.
Okay. On GNT?
No, overall. So to that extent, yes, GNT will be. But on that, this thing, on a larger one, larger period, I don't know the number.
And if one big geography, that's Europe, which is about 15% of your revenues, is challenged, is it not fair to assume that FY24 growth could be lower than FY23? Not getting into numbers, but...
See, that's the realm for the people who are going to make a bet on the stock. But for us, it's more about playing the market as it is. So, as I said, our stance in North America is very forward.
Sure.
In our stance in UK is very forward. Our stance in Europe is a bit more on the back foot. And we are playing it for individual ones and twos and scoring where we can.
Has pricing played out, Samir, the way you anticipated, the increase in pricing?
Like I called out, we are getting pricing improvements on a case-by-case basis. But given the inflation which the world has gone through, overall the expectation would have been that as a CFO at least, we would have seen much higher uptick. That is yet to come, and pricing reflects also over the quarters. It doesn't reflect in one quarter, but realization definitely has seen an uptick sequentially as well as year on year.
So it's played out as per your expectation.
Realization uptick has been there. Revenue productivity has been there.
Would it be more fair for you to say that the TCV range should be 7 to 8 rather than 7 to 9? Do you have that much skepticism over 24?
No.
So you could get TCVs above 8.
Absolutely, absolutely. And this 7.8 also, we have been on average above 8 only.
Yes.
So I don't think that need to reduce the TCV range or to narrow it down. There is enough. Again, as I said, the qualified pipeline which is the one step before that, is still continuing to grow, right? In absolute terms, it is continuing to grow. So there is no reason to assume. It is the decision making that is getting delayed. We are not hearing of project cancellations. We are not seeing people stepping back and saying that, guys, put a hold on everything. It's more of the delay in committing and starting of new programs.
So
we are being warned about time, so you ask your best question now.
No. $7 to $9 billion of a quarterly deal win run rate stays for FY24 as well, right?
I think it's a fair one, absolutely.
Okay. Does 26% now become a little more away from your reach margins?
First target get to 25% and then get
25
to nearer to...
25 you're saying is in the current quarter.
We are looking forward to 25% exit in this year, and then we'll try to get to 26 as soon as possible.
Okay. Gentlemen, it was a pleasure speaking with you, and let's hope the 41st quarter is going to be even more bright than the previous 40. Thanks a lot.
Thank you.
Thank you.
Back to you guys.